Financial trends in the automotive industry can be extremely telling to the overall health of the car market as a whole. This can give us insight into the demand, lending, and even the future of the automotive industry based off of delinquency rates. And once per quarter, Experian releases an automotive report that breaks down how the financials are within the automotive industry for the previous quarter. And so in today's video, I'm going to be breaking down this very recently released report that goes over all of the financial data for Q2 of this year. So let's get started. Now let's dive into my computer and let's look at this report. I will have the link to this report down in the description below, so that if you'd like to review any of the numbers, financials, or information discussed in this video, you can easily do so. So first, let's do a refresher of the different types of credit ratings for borrowers. We have super prime, prime, non-prime, subprime, and deep subprime. So whenever I mention any of these borrowers, this is the credit score range that I'm talking about. A super prime would be somebody with an essentially perfect credit score. Prime would be just below that. Non-prime would be below that. And deep subprime and subprime would be people with traditionally low credit scores, with deep subprime being the worst of the worst. The first page that I want to look at is an automotive financing snapshot of how and what consumers are financing. If we scroll down here, you can see there's a percentage of vehicles with financing. This is breaking down how many of new and used cars are financed. And this number has been steadily decreasing over the years, which makes sense because over the years, interest rates have been increasing. Of all of the vehicles that are financed, about 59% of those are used and about 41% of those are new. If we look over here, you can see the total loan risk distribution. Now what this is this is a breakdown of what type of borrowers and how many of each type of borrower is taking out loans. You can see here that super prime, for example, makes up 20.19%, while prime makes up 45.09%, which means that the majority of people that are borrowing money for the sake of buying a car, they are people with what we would consider to be good credit scores. With deep subprime borrowers only making up about 1.78% of all borrowers during this quarter, which is again what we would consider to be an extremely poor credit borrower, somebody with a 3 to 500 credit score. Now, the previous loan distribution graph that we looked at was for all of the loans combined, so it included new and used loans, whereas this graph that we're looking at right here is specifically for new loans. And you can see here that the vast majority of borrowers who are borrowing money to buy a new car are people that are considered to have good credit scores, with 32.2% of borrowers having super prime and 49.3% having prime. You can see here that deep subprime borrowers only make up about 0.25% of all borrowers for new cars, which is such a small percentage, and what really goes to show is that poor credit borrowers just simply aren't buying new cars, at least they're not financing them. Here we can see some data on how new loans are trending, and we can look at not only new loans but also new leases. So whenever it comes to the amount financed for new cars, this has been steadily growing over the years, though we have seen a relatively small increase from 2022 to 2023. In 2021, we saw $35,584 being the average amount financed for a new car. In 2022, that went to $40,587, so quite a significant jump over a one-year period of time. And this year, we saw an only slight increase to $40,657, so less than a $100 increase, which is a pretty big win. The average monthly payment has gone up quite a bit though. This is of course due to interest rates, and you can see here that in 2021, the average loan for a new car was $582. In 2022, it was $672, and in 2023, it was $729. The average loan rate has also gone up quite a lot for new cars, and currently the average new car loan is sitting at 6.6%, which is pretty astronomical. And this is where you can really begin to see the impact of credit score, because you can see here that the amount that super prime, so people with really good credit, are financing, and the amount that deep subprime, so people with poor credit, are financing are very, very similar. But the amount that these people are paying per month on their car payment is actually quite a bit different, with deep subprime borrowers having an average monthly payment of $744 and super prime borrowers having an average monthly payment of $694. And currently, the average new car for a deep subprime borrower is paying about 14% interest, which 14% for a new car is absolutely astronomical. This is something that has historically been pretty unheard of. Traditionally, new cars have lower interest rates than used cars, and while 14% interest rate isn't entirely uncommon in the used car segment for these subprime borrowers, it is something that is very uncommon, or at least historically has been uncommon in the new car space, and it's just crazy to think that people are paying that. Even 5% 5% in many regards is a unjustifiable interest rate for a car, so the fact that that is also the average interest rate for a new car for super prime borrowers is also very surprising as well. Well, I guess not surprising, as this is expected given the fact that interest rates have been going up over the last couple of years, but it is something that is a bit unprecedented. So in summary, when it comes to new cars, we are seeing less poor credit borrowers borrowing money to buy a car. The majority of people that are buying cars today are people with good credit scores. But even with these higher credit borrowers, they are still at the end of the day paying a higher purchase price, a higher interest rate, and a higher monthly payment today than they were this time last year. Now let's head over to used cars and let's look at some of the same data. There is a much more even split amongst the used car market when it comes to prime and super prime borrowers versus people that are near prime to deep subprime. So basically the same amount of people who have good credit are buying used cars as the people who have poor or very poor credit. You can see here that over the last 5 years, the amount of super prime and prime borrowers have increased. But you can also see that about 44% of used vehicle buyers are people that fit in that near prime, subprime, or deep subprime category, with deep subprime borrowers making up about 2.6% of all of the borrowers. You can see a breakdown of the rate as well as the amount financed and the term for these types of borrowers here. And you can actually see that the amount financed for used cars has actually gone down year over year, with the average amount financed in 2022 being $28,607 and the amount financed this year being $26,863. That is a pretty significant decrease year over year. But unfortunately, even though the amount financed has decreased by a good portion over the last year, because of the fact that the average loan rate has increased by quite a lot as well, it means that the average monthly payment has also increased. Whenever we look at this data broken down even further based off of borrower and risk status, you can see here that the amount financed by a deep subprime borrower is about $19,912, while the amount financed by a super prime borrower is $27,303. But monthly payments across the board are pretty much in the same territory. And even though super prime borrowers are borrowing quite a lot more money than deep subprime borrowers, their monthly payment is actually less due to the interest rate. You can see here the breakdown of the year-over-year change. The increase in the monthly payment year-over-year is actually quite a bit less than I would have thought. This is due to the fact that while interest rates have gone through the roof over the last year, the actual price for the car has gone down, sort of evening that out. So all things considered, the used car market is actually sort of flat in many ways year over year, which is good news. This is where things start to get a bit astronomical whenever we start looking at loan rates and loan terms for these borrowers. You can see here that the average loan term for a subprime borrower is 62.85 months, which comes out to a little bit over 5 years. And the same borrower is paying a 21.38% interest rate on their used car. Now we head over to delinquencies, which I know is something that a lot of people, including myself, are very interested in, and this is wherever the good news kind of turns into bad news. You can see here that both 30-day and 90-day delinquencies have risen. You can see here that the percentage of loans delinquent have increased from 1.99% to 2.28%, and the percentage of balances delinquent has increased by 2.29% to 2.72%. The 60-day delinquency status has also increased, with the percentage of loans delinquent increasing from 0.68% to 0.82% over the last year, and the percentage of balances delinquent increasing from 0.73% to 0.94%. Again, that's for 60-day delinquencies. 60-day delinquencies are predominantly occurring amongst used vehicles, and they are also occurring amongst independent dealerships as well. I always find the statistics to be really interesting, but it does make sense. Whenever we look at delinquency status, it is more often than not, the majority of delinquencies come from these smaller independent dealerships, not these larger franchise dealerships. And the reason why I believe that this is the case is because if somebody has poor credit or they're on an extremely tight budget and they just need to get into a car, they may go to these independent dealerships that offer those in-house financing options for less than stellar borrowers. Oftentimes these loans are very predatory, but again, if somebody is in a bind and they need a car, they may not have any other option, and as a result, they go to these independent dealerships with really bad loans. And because of this and these poor loan terms, these borrowers are at higher risk of going delinquent, which is why we see a disproportionate amount of borrowers coming from independent dealerships rather than franchise ones. So in summary, when it comes to used cars, the amount of money that people are financing and paying for used cars is actually going down. But because interest rates have gone up so much over the last year, the amount that people are paying for their monthly payment has actually gone up. But this isn't a terrible sign because it means that once interest rates go down, fingers crossed that this happens sooner than later, that means that the monthly payment for these used cars should go down quite a lot. And while 30 and 60-day delinquency statuses aren't going through the roof, and I don't know that we should be sounding the alarms today, I do think that this is something to keep an eye on because delinquency status have returned to pre-pandemic levels, and there are a lot of factors that aren't being taken into account. For example, the debt situation with consumer debt, student loan debt, the higher cost of living, as well as a slew of other factors. And I know that I am specifically going to be keeping an eye on delinquency rates very closely as student loan payments resume coming up very soon. But like always, you guys, I hope that you enjoyed this video. If you have any questions, comments, if you have anything to add, I would love to hear it. So make sure to leave a comment down below. And while you guys are at it, make sure to hit the like button, hit that subscribe button, and hit the notification bell. And I will see you guys in the next video.